Steve Glickman, one of the original architects of the Opportunity Zone project program, who now has his own consultancy firm. Quinn Palomino, who's a developer in Arizona, who's building some cool Opportunity Zone projects out in Tempe, Arizona. David Coelho, who's the Chief Investment Officer of Birch Investment, which is a huge investor in Opportunity Zones and has about $20 billion in assets under management. Before we begin, I want everyone to encourage everyone to get a subscription to TRD if you don't have one. That's where we make these events possible, and to continue to provide this type of information. So about 2 years ago, Opportunity Zones was the hottest program in real estate. Everyone was talking about it. It allowed investors and real estate developers to get major tax breaks and tax incentives for investing and building projects in low income and up and coming areas. But since then, some real estate developers have had some issues with the program of finding properties at the appropriate prices. The Treasury and IRS had some delays in coming out with guidelines. And then it's also come under some criticisms for mainly being used by wealthy developers to lobby to get their projects into Opportunity Zones, and that some of the areas didn't really seem to be distressed. But today I want to talk about the future of the program and what's going on now, and what's going to happen to the program in this kind of post-COVID or during COVID era. But the first thing I wanted to get to is there was the most recent news about Opportunity Zones was there was a report from the Urban Institute that detailed the program's progress, and it said that many people interviewed, many developers interviewed, said that they would have built their projects without Opportunity Zones, and the program hasn't really so far lived up to its lofty goals. Steve, I know you were quoted in talking about this report. I want your take first on what do you think what do you think about the report, and do you think the program has actually helped distressed areas and helped improve these low income areas?
Thanks, Keith. Can you hear me okay? Just want to make sure.
Yeah, we can hear you.
Okay, great. Well, that was an interesting overview of the program. I mean, I think this is a program that has had a lot more.
I can't hear you, Steve.
Yeah.
Pick up the AirPods. I can't hear you. Quinn, do you want to go first, or David, do you want to go? And then we can circle back to Steve.
Yeah, Keith, I think your question was just the impact of the Opportunity Zones and some concern about that. And I think some of your early comments are true. The initial novelty of the Opportunity Zones. There has been, most investors are focused on the coronavirus. So we have seen a drop off in that frenzy. Our goal has always been on social impact. So for our team, I know our two projects, we had a grand opening just earlier this month on the 16th, and that was 23 new jobs out in North Carolina in Winston-Salem. So we're excited to see creation of new jobs and affordable and workforce housing. So the Opportunity Zone that Steve and the team were instrumental in putting on, we can be used by those of us in development and investors to really give back to the community, especially when in the current environment, to be able to create jobs and housing for people.
Hey Keith, are you guys able to hear me now?
I can hear you. Steve, I don't know if Keith can.
I can't hear you for some reason, Steve. I don't know what's going on. David, can you go, and then we'll go back to
sure.
Steve, figure it out.
Yeah, sure. I can jump in. I think it's probably unfair to judge, the long-term impact of Opportunity Zones given where we are. And I would look at an example of our deals that we've been doing. I would say on average, these deals were in process for a good 3 years or so before they began construction. That's the nature of real estate development. Right, so it isn't as if the Opportunity Zones legislation gets passed, then suddenly you start building. And these projects take a long time to get entitled, to get approved. So, the first wave of Opportunity Zone deals are deals that have been in process in some cases for as much as 5 years in terms of our pipeline. But now that those maps exist and that's laid out, I think that over time you'll see more and more of these projects that probably would not have been accomplished without the Opportunity Zone capital. They'll have time to season and get to a position where they can take on capital. Right now, I mean, the capital that's out there that's interested in investing is going to go to the deals that are possible to invest and to come out of the ground. And that's especially true, and now we've gotten some relief, but with the way the existing, the original legislation worked, in terms of the amount of time you had to actually build these buildings, right, and essentially improve these projects, you couldn't take that entitlement risk. So you had to find deals that were basically shovel ready or close to. So I think as the legislation has time, and as the Opportunity Zones have time to season, I think you'll see a lot more projects over time coming along that would not have gotten done without the Opportunity Zone initiative.
Have any of your projects actually, would you have done any of your project without the Opportunity Zone program? I mean, would you have, one thing I've heard about most developers I talk to is, hey, we would have still done these projects anyways. It just kind of helped us a little bit.
I think it's an interesting question. I mean, for us, we probably would not have, we would not have been involved in this without the legislation. That doesn't mean that the projects that we're working on wouldn't have gotten done. I think that there's probably a mix of some that would have gotten done and others that wouldn't. I mean, one of the great things about the Opportunity Zone legislation from the perspective of an investor is it forces you to look at a 10-year investment horizon. And some of these markets, they maybe are a little tougher to do if you have a 3 or 4 year investment horizon. But if you're able to look out 10 years in the distance, I think we can get comfort around some of these investments that we couldn't on a shorter term basis. So I think that I'd say there's a mix. I think some of the deals we're doing certainly would have gotten done. I think they all would have gotten done eventually, but maybe they wouldn't gotten, maybe wouldn't have seen construction starts in 2020 for some of them.
Gotcha.
Hey Keith, are you able to hear me now?
Yeah, I can hear you now. I'm sorry, I don't know what's going on, but.
It was just a clever tactic to dodge your hardest question so that Quinn and David were forced to answer first. I think that worked out well. I wanted to, I think, make one other point though, and I think Quinn and David gave a really good sense of how things are looking on the ground. Urban Institute's report, which is the one I think you're referring to that got covered in the Times and Bloomberg and elsewhere, was covered pretty selectively, and that's not unusual for this program, which has become very politicized, right? It is a program that Donald Trump is using in his presidential reelection. There are both outlets and politicians who see that as a reason to oppose it, regardless of what happens in the program. So we should take, I think, all commentary on this program with a bit of a grain of salt. With that being said, Urban Institute's first and second conclusions was the most interesting thing about this program is it's creating a whole new ecosystem of economic developers and people involved in economic development, not just the private sector, but in particular African-American investment fund managers and developers who had found it much more difficult to get capitalized before this program, and we're now using this as a way to mobilize projects all over the country. And you've seen that happen particularly, I think, in sports and entertainment. Before Nipsey Hussle was killed, he was doing this stuff around Opportunity Zones in California. You've seen Derek Morgan do it in Tennessee, Luol Deng in Chicago, and there's lots of other examples from that. More broadly speaking, and this was, in part of, related to the quote I gave to the Times, listen, we're in the first year of a long program. The rules didn't come out till the end of 2018. We didn't see significant capital in the program as you would expect till 2019. We did see significant capital though in 2019, a brand new program, brand new rules that were still being finalized until the very end of 2019, raised at least $10 billion of equity. That represents probably $20 or $30 billion of projects, and probably a lot more than that because many of these deals are single asset deals that are being done all around the country that aren't really captured in this fund level data. And a lot of that's dry powder. I mean, a lot of that powder has to go into the marketplace, and we'll see both what sort of projects those go into. And I think there's a mix. You can anecdotally, which is all Urban Institute looked at, they anecdotally looked at a few dozen people they were in contact with the marketplace and come to lots of different conclusions about the marketplace. But you won't really know its economic impact for years. Because even if, let's say, and there will be a lot of first wave infrastructure and real estate projects over the next couple of years, that's a lot of the primer you need to do lots of other things in marketplaces that have been historically undeveloped for decades. You're not going to solve that problem in 1 year. And it's not a cure-all. There's a lot of other issues in distressed communities that have to be solved simultaneously. But I think in terms of its first goal, raising a lot of capital, empowering a bunch of new fund managers, you've got over 500 Opportunity Zone funds, many of them coming from underserved communities and who don't represent your typical fund manager in the real estate or private equity marketplace is a huge win. And given how popular this is, and there's a huge survey that was done, I think, by Boston University among mayors who overwhelmingly support this program, feel like the zones were put in places by their governors where they wanted to see it, and I've seen a lot of promise for the program. So it's too early to judge. There's just as many positive signs as there are troubling ones. And there's this underlying dynamic of the 2020 presidential election. I think people should hold their breath a little bit and wait to see how some of this stuff develops before they reach any kind of sweeping conclusions one way or the other.
Right. I mean, I definitely think it's fair to say that it's too early to see, you know, what are going to be the long-term impacts from this. But you mentioned one part of how African-American developers are interested in the program for the Urban Institute. But one part of the report that I mentioned is that they're having issues getting investors, and that is that they're having trouble getting these investors either because they're you know, maybe new developers, not as experienced, they're going into new areas, and that there's a disconnect between, yeah, these ideas sound really good, but how do we get investors to buy into that and actually say, yeah, you know, these returns make sense, and yeah, we want to keep our money in there for 10 years. So maybe Quinn or David, can you answer, like, what are your investors saying to you, and how do you attract investors to meet these goals?
Keith, I think you've hit on something. I think since coronavirus, you do see many investors kind of taking a breath. The retail investors, I would say, has dropped off quite a bit. You see the ultra high net worth or those very sophisticated tax advisors providing feedback and input. Those are primarily where you see many of the investors kind of accessing the opportunity zones. Definitely a frenzy and an initial spike among retail investors, but especially since coronavirus, we have seen the typical retail investor dropping off.
Yeah. So, David, do you want to go?
No, I was just going to say, I mean, I think that you know, our job in a lot of ways is really to find good developers and wrap them with good projects, and we can. You know, we generally work with, you know, a mixture of national developers as well as, you know, local regional sharpshooters. So for us, you know, I think we would be, you know, more than happy to back deals that are brought by minority sponsors if we can find good deals in good markets. We don't focus everywhere, though. You know, we don't focus on every market. We just simply don't have the bandwidth to focus on all 50 states. So we have a lot of different markets covered, but not all. So I think where we are, you know, in the markets that we cover, we do try and really see all the deals that we can in those markets. And I think that, you know, if we find, you know, deals that pencil, you know, we'd be happy to sponsor anyone that has a qualified deal for us.
And are you talking about that? I just want to go off that. I mean, you talk about penciling out. That's one thing I've heard as a challenge from local developers who I've spoken to, is just how do we make deals pencil out? Because it seems what happened is a lot of people thought they hit the jackpot when they saw that their site was an opportunity zone site. The land prices went way up for a lot of these sites. And I just heard from a lot of developers, hey, it's just tough to kind of make this program work out, and it's complicated, and it's not as easy as what was made out to be. So David, I mean, how do you make these deals? Like, what do you have a strategy as to how you make these deals pencil out consistently?
Well, I mean, I think you hit on something that I think has become less of an issue over time, but was a very big issue at the beginning of 2019, is that anyone who owned land in an opportunity zone thought they hit the jackpot. But the fact of the matter is, it just doesn't really work that way. The opportunity zone, while a powerful initiative, it can't take a bad deal and turn it into a good deal on its own. So when you have folks in opportunity zones who now wanted a 50% markup on their land, well, you're right, the deals just don't pencil. So, you know, a lot of what we were able to do in opportunity zone phase 1, where, you know, really deals were coming into pricing that had already been established pre-opportunity zone. And anything we were looking at that had had land that was for sale but not under contract, you know, quickly stopped making sense. I think, though, that as time has passed, and, you know, I think owners have started to realize that, you know, the value of their land is maybe more than it was pre-2018. It's not 50% more than it was, and it's probably not even 25% more than it was. And as land sellers' expectations become more reasonable, I think we're seeing more that will work at the current market. But there was a time, I'd say the first 6 months of last year, where we wouldn't really look at anything that had land that was available for sale. If it wasn't under contract, we didn't want to look at it because the bid-ask spread was just too wide. But when you take investors who are interested in this program, and depending on how you do the math, over a 10-year basis, we think the tax incentives are worth, call it 225, 250 basis points.
And you've seen the land prices come down now, though.
Say again?
You've seen the land prices come down more recently.
We are seeing land prices come down more recently, but the point I was making is when you factor over 10 years, you're getting a 200 to 250 basis point spread just for the tax return, or for the tax incentives, call it. Depends on your assumptions. So there are investors that will find that very interesting, but they're not going to take a 5% return to get a 200 basis point, increase in returns on a post-tax basis. Right? They're still going to want returns that are similar to what they would get on a 10-year basis. And if you extrapolate that backwards to a 4-year, 5-year investment deal, it starts to look similar to a regular way, development deal. So there's just no room for opportunity zone investors to pay 25, 30, 40% more than the opportunity zone land value. And that's before COVID. That's before you factor in COVID and what's happened, at least in certain markets, with respect to pricing over the last 3 to 4 months.
Right. And I got you. I guess I kind of want to go into that now. I mean, it seems like everything we're looking at now and just in real estate in general has changed so much. It's hard to make any sort of valuations or assumptions about what the future of the office market will look like, or the future of retail, hospitality. So what is changing now in opportunity zones in relation to the coronavirus and COVID? How has the strategy changed? How has investors' appetite for this program changed? What's different now than maybe 6 months ago?
Hi, Keith. I think David definitely hit on it. You definitely see the prices on land. We see it across the country. They've flattened out. There was definitely the initial bounce that you saw during the frenzy. And the appetite of the investors, historically, people have been very interested in urban, high density, I think the pendulum has shifted. Most of our investors are looking at high-rise buildings and thinking people are a little too close to each other. Maybe that's not the right investment in a post-COVID world. Now think single-family residential rentals. We are seeing a lot more investors who they're looking at what does the post-COVID world look like? And some of the products are a little different coming out of that.
Gotcha. So
that's what we're seeing, kind of boots on the ground.
What are they looking at now? Steve, what are people telling you? Where are they looking right now?
Some of our investors, go ahead, Steve.
Oh, no, go ahead.
We still have a lot of our investors interested. We have many of our investors who are more social impact conscious, so they like to see still the number of jobs being created. They want to make sure that there's affordable housing being provided. Some of our investors, as they look at the product, as they weigh out, they do like something with a little bit more. They look at the South, the Southwest, the Southeast, looking at areas that perhaps a little bit more spread out, healthier kind of living where people aren't packed so closely. That's something that has been more of a concern in the post-COVID world. So you definitely do see a pendulum. I mean, think rather than high-rise building, think single-family residential rentals, kind of a little bit more spaced out. We've seen a lot more of discussion, and an interest in those products kind of across our portfolio.
Does that fit in with opportunity zones, though, the single-family rental model? I mean, can you?
Those are in opportunity zones as well, same product.
Okay. David, do you have any?
Yeah, I'm able to see a bit of a kind of a national footprint of what's happening in opportunity zones. I think there are some opportunities, and I think some people are going to have to change their focus areas, but it all broadly tracks, and this is true about opportunity zones in general, it all broadly tracks what's generally happening in the private equity and real estate market to the extent that's the sort of OZ investor you are, and true for other types of asset classes as well. Specifically in OZs, one, there's a lot of dry powder now, much more so I believe than there was last year. And the key thing to realize about OZ capital is the most important thing for OZ capital is that there are sales. And there were lots and lots and lots of sales in the stock market, which now we know you've got till the end of the year to reinvest. That include tons of capital you had to invest that was captive from 2019 through partnerships that now you have until the end of of 2020 to reinvest. And so there is now this, I think, quite a bit of capital in that marketplace. That tracks broadly the private equity real estate market, particularly in opportunistic and value-added funds, where there's $200 billion of dry powder, and there has been for years. And I think the reason there was so much dry powder is it was speaking to an issue that Opportunity Zones address really well. We were at the end of a cycle. Why would you go in and make a long-term investment at the end of the cycle? Now we're arguably at the beginning of a new cycle where you got cheaper prices. When you got cheaper prices in a long-term hold and lots of dry powder, it's a really good recipe for OZs. But I do think that not all strategies are going to work in this environment, just as they wouldn't work in the general private equity universe. I think hospitality deals are really hard. I think retail deals are really hard. I think office deals are really hard. I think multifamily is still the king of opportunity zones, as it is in real estate. It's where most of the money went in 2019 into these projects. And I think also geographically, you're going to see a big trend line, which I thought you'd see years ago, which is it's tough to invest in Manhattan and San Francisco in these very, very expensive markets, particularly now. And it looks like the trend lines are people are moving to some of these second tier markets that happen to be a lot cheaper and happen to not, their opportunity zones happen to be in their central business districts, in their downtowns, or not at the outskirts like they are in markets like in San Francisco and New York and DC and elsewhere. So I think there's a big opportunity for this marketplace. I still think there's a lot of people out there who don't fully understand OZs, or even more importantly, don't understand the footprint of the fund managers and the players in that space, because there's a lot of new fund managers, a lot of new investment groups that have formed around OZs. I think that's broadly a good thing. But again, it's just going to take time for this stuff to shake out. And I'm very bullish about OZs this year, next year.
David and Quinn, are you looking at opportunity zone sites now? I mean, are you actively searching sites? And can you tell me, like, David, maybe what's the competition like? What are you seeing in terms of like, who else is looking at these deals, and what are you looking at?
Well, I mean, we're very active, and I would echo, precisely what Steve said. I mean, last year we did about 70% of our aggregate value investing in opportunity zones was in multifamily. In 2020, I wouldn't be surprised if it's 100%. We are really principally focused on multifamily right now. I would say we're seeing less competition than we have in the past. We've seen a lot of competition, frankly, from, to your point earlier in the conversation, from non-opportunity zone capital. I think a lot of that is on the sidelines now. I think that, a lot of investors are surveying the universe, want to determine whether or not they'll see distress opportunities, and are less likely to commit capital to development deals, which is, by the way, generally the best time to commit capital to development deals when nobody wants to develop. And I think we're seeing more of that today. So I think from our standpoint, we're very bullish on the opportunity because we do see less competition. We do see costs coming down.
So the private equity firms haven't gotten in there yet. Have the private equity firms like the Blackstones, Brookfields, that have, as Steve mentioned, this huge war chest of dry powder? Have they gone into this space at all, or have you had to deal with some?
And no, and they're not going to.
Oh, really?
They're simply not going to. I mean, their investor bases are, for commercial real estate, with the exception of like a B REIT or Star Wars non-traded REIT, it's entirely institutional,
right?
And principally non-taxable. So they're not going to come into that space. And I think that they're, there were maybe 10 billion, probably more, that was raised, to Steve's point, last year. I don't think we're going to see hundreds of billions of dollars raised for opportunity zones. It's very difficult to raise money for opportunity zone deals. It's complicated, it's hard, and you can't get somebody to write a $100 million check very often because that's got to be a taxpayer. So we are seeing certainly competition for deals, but less competition than we saw last year. And I think we're frankly probably seeing more and better deals than we saw last year in this environment. Even if our rent assumptions are reduced, we've taken rents down in our underwriting. We're seeing costs come down in most markets. I wouldn't say all markets, but in most markets, we're seeing costs come down. And I think we see a lot of good defensive opportunities, and especially when you look at it on a 10-year basis, multifamily as an asset class, you can't find a 10-year rolling return where multifamily doesn't make you money if you're appropriately levered. And
opportunity zones make you more money than in non-opportunity zones. I mean, I guess I'm trying to see, like, what's the value for an investor? Like, why wouldn't you just, why invest with you guys for an opportunity zone for someone else who's in a non-opportunity zone? What's the difference for an investor?
Well, I mean, from our perspective, I would say that, I think if you were to take a non-opportunity zone multifamily investment versus one of our investments and stretch that over 10 years, they're going to look the same, with the exception of the fact that you're going to get the tax benefits from our investment.
And is the 10-year hold, Quinn, maybe you can answer this, is the 10-year hold, is that hard to get investors to buy into? I mean, I can speak to my generation, maybe, 10 years, that sounds like a long time, I don't know what I'm going to be in 10 years. So what is that? Well,
for us, that hasn't been an issue, partially because of our strong management team, because we always feel like it's not just the day you stick the shovel in the ground, but we want to make sure our projects, we get them done on time, on budget. And then even after we open the doors, they need to be managed properly, because they need to withstand and be operating and cash flowing within those 10 years. So that is something that I know many of our investors, and we feel pretty strongly about opportunity zones. And as David shared, you see a lot of those who kind of jumped and quickly jumped on the bandwagon. Some of those have fallen away. Those of us who've just kind of realized that the management piece, actually executing and completing the development projects, is critical. We're a private equity firm, so in this environment, we've also focused on a lot on distressed companies, assisting companies on bankruptcy. So that's our focus. That's an area of focus for us as well. But opportunity zones, I think it's just a little earlier, you and David were speaking about private equity, kind of reason why not stepping into that. Kind of the traditional areas for private equity would be distressed value add properties. And so that is a big part of our investment as well.
Your background, a lot of you have hotel investments, and that's kind of, some of what your development group is known for. Are you looking at any hotel projects now in opportunity zones? I mean, what is your kind of take on maybe investing in a hotel asset right now in an opportunity zone?
Right now, so our two properties that have already completed, one, the residential that I shared with you earlier, the hotel we just had opened in an opportunity zone. Again, that's creation of jobs. But right now, as the property, you've known, the hospitality industry got a big hit when the shelter and stay was mandated across the country. So there are a lot of opportunities on distressed hospitality, those who need capital. So a little different than opportunity zone kind of ground up development. So unless we've stepped in on those distressed properties, as well as those that have already been built and they're just looking for their PIP, their property kind of income capital that's needed to improve the property. And we've stepped in on those hospitality projects as well. Some of those tend to they're not in opportunity zones, and since it's not a new development project, don't qualify for O zones.
Got it. Steve, have you heard of any alignment with opportunity zones and kind of distressed investments and setting up these funds? I mean, I'm just writing about them all the time, of new distressed funds. Are you seeing that too, of kind of this pairing of opportunity zones and distressed funds?
I think it makes a lot of organic sense, but what I'd say realistically about the marketplace is most of the market's still sorting out the impact of COVID on basic operations. And the idea that you're going to take distressed assets, which are a pretty complex asset class, and OZs, which are a pretty complex product, and combine them within a couple months of going through all this, we're probably, to the extent that is happening, not going to see it shake out for a little while. I do think a lot of the folks you'll see move are those that have had success raising capital in 2019 in the OZ space, and now have a product that they can put out in front of investors and a track record for all this new capital that's in the marketplace. By the way, I think this would have been true regardless. I think one of the things you're going to see happen in the OZ marketplace is a lot of the funds that were started in 2018 and 2019 aren't going to be able to raise the capital they thought they could raise, and they'll end up falling out, and will leave a more concentrated set of funds and players in the marketplace at the fund level. There's always going to be these single developer deals all around the country. And of course, we're spending a lot of time talking about real estate, and that is a big chunk of the market. This market is way broader than that. There's a big need now in terms of distressed assets when it comes to municipal deals and utilities, and telecom infrastructure, and renewable energy, and entertainment, and tech companies, all deals I've worked on or with in the OZ space. There's lots of reasons it's not catalyzing in the same way real estate is, and we shouldn't expect it to. A lot of these markets need real estate first. Real estate's also a much more natural asset class for tax incentives, because for lots of reasons, operating businesses can't take advantage of them. They're either not profitable but the ones that do have a lot of growth in these zones, this I think is a very interesting asset class for the right type of investor.
Gotcha. And then what, I mean, just in terms of like, what are investors, what are you got, what are you, Quinn and David, what are you looking at now? Like, what do you think is going to be the next maybe asset that will be, or the next market that will be really prime for an opportunity zone land? Like, is there any, I know you talked about multifamily, but is there anything else that really seems to be, you know, an attractive asset class, an attractive deal to make right now?
Just keep, you know, from our perspective, I mean, we are really at this stage focused on multifamily, simply because it's just too uncertain to know what the future is going to look like for other asset classes. Which, you know, I'm not suggesting that I'm predicting the demise of any of them, but I think that they will be impacted. And frankly, one of the things that we have to be concerned about always in opportunity zones and development is financing. And getting an office building financed right now is very, very difficult. I think logistics are really interesting, and you know, we have not historically been a big industrial player, but I do think that's another space that should attract opportunity zone capital from a real estate standpoint. And you know, we would like to do deals if we can find good deals to do in the industrial sector. I think that's another very interesting one, and frankly, where capital should move to as well. And then the other thing is you know, we others alluded to earlier is, you know, a lot of what we've been doing anyway is a little more of suburban. You know, and Quinn was talking about this, not so much single family, but certainly kind of garden style suburban,
Right.
wrap deals, low rise deals. I do think that those markets a lot of the markets that we were already focused on, the high growth secondary markets, frankly, I don't think that there's going to be some dramatic change. I think the long-term trends have been in place. You know, you see it with Austin, with Nashville, with a lot of the Florida markets. I think that probably accelerates, at least over the near term, with the demographic shift into those markets. And I think that those will continue to be the winners. And not to say we won't do high rise, but I do think that, you know, kind of the low rise garden style type deals are probably a safer play in 2020 than some of the, you know, more competing kind of downtown urban ones.
Gotcha. And then in terms of financing, what's kind of the market right now for opportunities and financing? Is it hard to get? Different? Is it different anyway? I mean, I know you talked about just getting financing for office, but is it different for opportunity zones in any way, or does it kind of follow the trends as to what we're seeing more broadly?
I mean, you know, the capital markets were hugely disrupted by the events of March and April, and continue to be. So I think I think we have certainly seen it. The construction financing market is nothing like it was in February.
Right.
I mean, I think that there's financing available for good deals at reasonable leverage points. You know, folks that were trying to get 70 to 75% loan to cost, that is very difficult to do now, if possible at all. I mean, a lot of the debt funds that were providing that debt are just not in the construction financing market. So there's a lot of players that just are no longer interested in construction financing. I think that's probably going to be the case for the balance of the year. But there is still financing out there. It's more expensive than it was, but there still is financing out there. And, you know, we continue to get term sheets, and we closed one loan last week, and we're signing 2 term sheets this week. So it is out there,
Right.
But it's nothing like it was earlier in the year.
Gotcha. And then what percentage, Steve, maybe you can answer this, like what percentage of the OZ deals as far as syndicated in terms of financing? Like, do you have any idea? That's one question we got. Like, do you have any idea as to, in terms of how the financing is being done?
It's anecdotal. I don't think there is actual data out there, but every deal I've seen in the OZ space for the most part is leveraged. I think those, to David's point, who are leveraged, who are using more conservative leverage, let's say, you know, 50-50 even, are going to do okay. Rates are low. They're going to be low for a really long time. And construction prices are really low. That's a good combination. I think it's just like it's very hard to judge the Opportunity Zone program from last year and projected out 10 years from now. It's very hard to evaluate how things are going based on the last few months. This is a unprecedented, crazy time in the world, and it's crazy for everything. It's crazy for every type of deal, including OZ deals. But a lot of the fundamentals are there. Lots of capital, low rates, cheap construction prices, long-term holds in the types of markets that were pretty much priced roughly where they were before. I mean, I really do think it's the bigger, more concentrated markets have seen this huge drop and have enormous amounts of concentration and are way overpriced, I would argue, already. The markets that aren't still aren't. And those are where I think a lot of interesting long-term deals are going to continue to happen over time. I don't think there's anything fundamentally different about the market, but in the short term, things are going to be challenging to get anything together. I think that's why you've seen all these extensions in the program. You pretty much don't have to do anything in this program until at the earliest end of the year, more likely sometime in the beginning of next year. I think we're all hoping that things have shook out a little bit by then, and it'll be easier to operate in the capital markets. It'll be easier to figure out deals. It'll be easier to due diligence this stuff for both the banks and the funds. Keep in mind, due diligence is way harder now than it used to be. You can't actually get on the ground in these projects, meet people, see the land, see the project, meet the construction guys, meet the city. You can't do any of that stuff in the same way. And I think the government's been pretty realistic that we'll need more time on that. And I think we're going to have more time hopefully that's all we need.
So, I mean, it's interesting because like originally, the Opportunity Zone program was highlighted in these deals in New York and Miami and these big cities. But now it seems like as people are moving from New York to these other places, are there going to be new Opportunity Zone deals in, I don't know, Wyoming or in some of these more rural places where there's, like real land is much cheaper and, there's some maybe like a former mill town or something like that that has the infrastructure that can be redeveloped. I mean, do you guys see that?
Keith, that's so interesting. That's so interesting you say that. We're seeing a trend. People don't, with international travel kind of slowing down, you don't see a lot of international travel. Areas like New York, Las Vegas, the Bay Area, we're seeing people want to get in the car and drive. They're a little gone a bit stir crazy with their kids all trapped in a house. And so even this summer, we're just seeing spikes in occupancy at hotels just across the country. Drive-to locations are much more popular. We like the residential, the multifamily products, garden style. I think what David hit on exactly what we're finding to really work. But on the hospitality, as those owners and investors who perhaps not very well managed hotels, we're seeing those really struggle and disappear to the sidelines, where those that are very well managed and in locations by highways internal to the U.S. rather than on the coast, where families want to travel, we see a definitely spike. The Florida Panhandle, we saw numbers up at 100% occupancy during coronavirus. Even the Texas Panhandle. So there's a lot of, you have drive-to locations off the interstate. You're definitely seeing the U.S., just kind of the population accessing those areas of our country. It's pretty interesting.
So are you reconsidering deals that you would have never thought about, before this? Are you looking at places that you maybe didn't even know about really before the? A
lot more. I know the team, our underwriting team, our performers, definitely looking at areas and just seeing what the new drivers that are created now and how many of those are sustainable. And so definitely, absolutely, Keith, just re-looking at it and seeing what areas really, what the needs are moving forward.
Gotcha, that makes sense. And then, one of the last points I want to touch on is there is a lot of uncertainty around opportunity zones, but the Treasury and IRS did release some new rules that, I know, Steve, we spoke about this and how that can possibly help the program and boost the program's investment. Like, what do these new rules mean for the program, and how does it help? And how do these new rules help the program? Yes.
There was a bucket of COVID relief related regulations that Treasury and IRS put out earlier this month. And they actually put out some additional changes in April that were kind of unrelated. But there's really two big takeaways, I think. One is that investors have a lot more time to invest in funds to the extent they had a rollover event after April 1st. So that means they could have sold as early as October, November of last year, or all the way up, through any time this year, and they have until the end of December to reinvest. So that provides a little bit more time for investors to get to know the market. I think maybe the bigger impact, which is really important for funds, ties into this conversation we had earlier about due diligence. Funds had until June 30th to deploy 90% of the capital in their funds into qualified assets. They now have at least till the end of the year, maybe depending on how you read the rules, until June 30th of next year. And what that means is, I think you've added a bit of a pressure relief for funds that were having difficulty sorting out and finalizing deals because of all the issues we're talking about in the marketplace, that now have some breathing room to get it done. I think they were necessary steps towards other pieces that were built into those rules that basically enable you to take more time to get deals done. But one of the things that has happened over the last year or so, is that Treasury has provided a lot of time for investors and funds to get deals done. You've got now up to potentially 8 years to get or rather 7 years to get deals done. You, as of course, have about 5 years to get a deal done in your Opportunity Zone fund. That's a healthy period of time because funds are incentivized to get these cash flowing as soon as they can.
Gives them more time. Gives them more time to
see the returns. But now you got more time to do it. What that means is I think you got more time for multi-phase developments. You've got more time for stuff that's complicated that requires government involvement. I think David made a really good point earlier. This asset of industrial, one in the program is treated totally differently. Brownfield assets are basically treated like they're new developments. Two, there's lots more of them around the country. Three, I think that ties in very interesting with what you see happening in manufacturing in the country. So I think that could be a huge additional trend line. And those aren't necessarily urban deals. Some of them are going to be urban. A lot of them are second-tier markets. Some of them can be rural. So I think that, and as it factors into logistics, I think that would be a very active asset class in the OZ space over the next few years as well. And those are entirely different types of projects, entirely different parts of the country.
Right. I mean, I think the last question I just want to ask is, now we're in a time where there's a lot of deep conversations about what needs to be done with in terms of what needs to be done to improve the country and what, I guess my question is, what needs to be done to improve the Opportunity Zone program? I mean, you guys are all very bullish on the program. You're active participants in it and you're believers in it. But what are some things that maybe tangibly can be done to really make sure that there is a real impact in the program and that it's really meant to boost communities and go into distressed areas and improve the livelihoods of these people in these areas. Quinn, what do you think?
I think measuring the social impact, that's something I've asked my team. We're very focused on making sure how many of the units are providing affordable housing, how many are providing workforce housing, how many jobs are actually being created, and we're following those jobs and making sure we're providing the training so there's a pathway for those individuals, even if it's an entry level, that they get a chance to move up to the middle class. I think as those results, we've got our openings on our projects, as those results come flowing in, being able to document that and providing it to everyone else so that they can see that there is definitely, done right, we definitely have an incredible opportunity, a once-in-a-lifetime opportunity to really give back. And that means give people a safe place to live, and give people a job that they know they can go, it's not a clock in, clock out, and they can actually have an opportunity at a career in the middle class. So that's something I think is critically important as we measure that and being able to share that information so others can take that same model and provide those opportunities on their projects as well.
Gotcha. David, what do you think?
I mean, I think Quinn hit on the biggest issue from my perspective with respect to the legislation and subsequent regulations is the lack of required reporting. Right. I mean, I think there needs to be accountability and transparency for what's being done. We have also focused on a lot of workforce housing and affordable in most of our projects, not all. I mean, Opportunity Zones, a program like this, it is not a silver bullet. It's not perfect, right? There's always going to be things that fall through the cracks. I think there are certain types of deals that fall through the cracks that should not be, and those cracks should probably be closed, and those shouldn't be able to happen. And that's unfortunate, but it is what it is. I think the best that we can do is insist on reporting, and we do have an impact fund, a workforce housing fund that is separate from what we do in Opportunity Zones, but we commit to the same level of reporting that we do in our impact fund for this. So I think that's probably the best thing that we can do. I think if you try and be overly restrictive, you look at kind of like the proposals that come out of California, and I actually don't know where they stand, but some of the proposals of California where they would only, initially they're talking about only providing Opportunity Zone benefits for, 50% workforce housing or green initiatives. It becomes, it really kind of tends to, make the whole program less effective. I just don't think it really attracts the capital. So I think you do need to have the flexibility to do some things that maybe aren't going to fit into the box perfectly, but that's why I think reporting is so important. The other thing I would say from the on flipping the switch on the other side, from the fundraising side, I think the biggest weakness with respect to the legislation is the uncertainty over the future tax rate that tax will be due in 2026. I think that, that was, I don't want to say it was a mistake because maybe it wasn't, but I think if investors had more certainty over the tax rate that they'd be paying, if they were paying the 2020 or 2019 tax rate in 2026 and they knew that, I think that would probably solve the biggest piece of uncertainty for investors coming into the program. But I think some folks might look at this and say, well, my tax rate on capital gains could be 40% in 2026. I just don't know. So I think that's the biggest issue on the kind of the incentive side from an investor standpoint.
Steve, I mean, you're instrumental in helping create this program, and you're one of the leading speakers on this. So what do you think? How can we make this program?
Well, I think this program was designed perfectly, so I'll just say that for the record. Listen, I have bias built in here, but the program is so far doing what we set it out to do, which is create a whole new asset class, raising a lot of capital, get people talking about these communities that have been overlooked for decades, and get people mobilized in these communities to start to figure out ways to attract this capital. That is all happening. It's not a substitute for a lot of things we need to do more of. We need to do more low-income housing tax credits if we are serious about building affordable housing. We need to provide more benefits to get people working, to get them retrained. This is one sliver, but this is a program, and I think we as investors, and to our investors, have to look at ourselves too. This program is heavily driven by investors and what they want. To the extent they want impact, I work with funds that do tons of impact. To the extent they want to do deals with cities and states, I work with funds that do deals with cities and states. To the extent they want venture or entertainment or manufacturing, I work with funds that do all of that. But investors so far are looking for pretty risk-averse stuff. And to the extent the investor community doesn't get more mobilized around driving impact in what they're requiring from fund managers, you're not going to see as much of it reflected in that universe. And we have I think a bit of an overinflated view of what impact investing is actually doing in this country. When push comes to shove, a lot of those impact investors are still demanding market rate returns, which is to say, this is a big ecosystem that we all got to fix together. The OZs aren't going to solve this thing. We need government to step up and do more. We need private sector investors to step in and do more. We need cities to engage more. We need developers to do more. We are not doing enough as the country to fix these long-term problems in these marketplaces, but I do think opportunity zones are a really powerful tool to getting in private sector in a way you've got really no replacement. And in providing a new focus from economic development, organizers around the country in a way that they hadn't had for decades. This is the first new place-based program in 20 years. In its first year, I'm pretty proud of it so far, despite what the New York Times or Bloomberg or what the Real Deal says about it, which is always positive. So I have no qualms there. And let's keep pushing it. Let's push for more data. Let's push for more transparency. That was all built into the original legislation. And let's push for the type of projects we want in our communities. At the end of the day, any community can stop a project it doesn't want to do. So to the extent projects are happening, it's because they have the city council and the mayor, unless you're Houston. Houston doesn't have that power. But in every other place around the country, your city council, your planning commissioner, your mayor, your community groups can stop stuff it doesn't want to see done. And for the most part, these are projects that communities want to see happen. They may not be the only thing they want to see happen, and they're not certainly the only use of the OZ program. I think we're going to see that grow and get more diverse over time. So I'm bullish on how this has been going and how this is going, and we'll have to wait and see.
Okay. Well, on that, I'll leave it there. I'd like to say, though, that I think that a lot of the work we've done has been critical. I don't necessarily see it as positive or negative. My job as a journalist is to report things objectively and independently, just to say that we don't see positive or negative stories. So
be objective as long as it's positive about the program. That's the only thing I ask.
Exactly.
Not. I don't know. Well, I appreciate you guys being here. I really, this is a great conversation, and everyone listening, please subscribe to The Real Deal to have more of these conversations and more of this information to help you guys. So thank you guys so much, and take care.
Great.
Thank you.
Thanks, Keith.
Thanks, Keith.